Hello, folks. Welcome to this episode of Rich Insights. I'm Don Rich. Today's topic is on investment grade credit. Avoid it. All right, this is like your in-laws, right? You want to avoid this. This is like dealing with your in-laws without alcohol, all right? Or even any controlled substance for that matter. This is not a pleasant environment. All right, so what has happened? Spreads have come in so much that there's just no juice left on the table. The risks are so asymmetric. Now, what has caused that? Well, we're looking for substitutes for the risk-free assets. Since interest rates are so low in treasuries and government bonds, we're looking for substitutes, right? And we're looking at risky substitutes for risk-free. Things like gold, investment grade credit, hell, high yield maybe, or even emerging market debt, right? Things have gotten crazy, right? Spreads are so tight. So the message is going to be investment grade credit looks the worst of the three, right? Out of investment grade, high yield, and dollar denominated EMD debt. Investment grade to me right now looks the worst. But none of them are particularly attractive, right? None of them. Spreads have come in so much on all of them. But if you have to be in fixed income, you probably want to think about either high yield or EMD. All right, so let's get into this. I'll show you why. All right, the blue line here is the spread on investment grade credit. The blue line is investment grade. The brown line is high yield. So investment grade is paying 1.3% above treasuries, 130 over. All right, it's paying 130 over. Now, let's take that back. Now, first thing we can notice, sort of these pre-virus or early virus levels, we're back to that point on both high yield and investment grade. All right, they're both equally unattractive from that perspective. But let's say if things continue to improve from here, right? If equities continue to run, the Fed continues to pump in liquidity. If this Goldilocks environment continues, how much better could things get? Well, again, let's take a look here at the blue line. We're 130 over now. Maybe it gets as low as 100 over. 100 over, right? So there's 30 basis points of possible tightening in sort of the best case scenario. 30 basis points? Are you kidding me? Right? Oh, let's contact the Kardashians. We need to alert the world. There might be 30 whole basis points we could pick up, for Christ's sakes. What's on the other side? We might pick up 30, or we could lose, right? Spreads could widen 200, 300, 400, 500 basis points from here. That's what I'm talking about. The risks are so asymmetric, it is ridiculous. Now, high yield. Again, high yield has, the brown line here, high yield has come in tremendously as well. It's back at its pre-virus levels. But let's take a look. If high yield continues to tighten, how much tighter could it go? Well, maybe 300, 350 over, right? It's 5% over today. Maybe there's 150 to 200 basis points left. That's not great in the best case scenario, but at least we got some breathing room, right? We have some opportunity to make profit. All right, that's just not the case with with investment grade. So let's look within the investment grade category. What is causing this? And the quick answer is everything. So here we have the individual investment grade categories here. The triple Bs, the single As, and the double A's. Now, again, remember, the entire index was paying 130 over. And so the entire investment grade index is a combination of these three. And what we can see as we look at the time series of these spreads is that they have all collapsed, all right? They're all essentially back to pre-virus levels. What does that tell us? Well, there's really no pockets, even within investment grade, that we could, chase. Right? There might be some individual bonds, but there's not pockets, right? Everything is tightened so much. But most people don't trade individual bonds, right? The problem with individual bonds is they don't trade that much. And if of course, you have the liquidity risk there. And then if you do find them, they mature, and then you got to reinvest, find, some new bonds that don't trade. So most people actually will trade fixed income ETFs rather than individual bonds. Right? So if you're going to trade investment grade bonds, LQD is probably the most popular one. There are other ones, but LQD is the one I'm most familiar with. But again, right now, I'm not suggesting that looks attractive at all. But within high yield, there's two you want to think about there. HYG and JNK. They're both high yield ETFs. They're both high yield. Now, what's the difference? Well, not much. There's a slight difference. High yield tends to be a little higher quality. HYG, rather, tends to be a little higher quality than JNK. All right? A little higher quality. I mean, the credit component tends to be a little bit higher than JNK. So a little bit better credit risk or less credit risk. All right? And it tends to be a little bit shorter in duration. So you got less interest rate risk. But there's not a whole lot of difference between the two. HYG tends to be a little safer and have a little smaller, less return than JNK, right? But those are the two you probably want to think about. So if we're thinking about JNK, or if we're thinking about high yield as a possibility, the one thing we want to make sure of is that high yield's not being driven all by one credit category. Okay, so here we have the spreads again for all the high yield asset classes. The double Bs, single Bs, and then the triple Cs, right? The ones that are closest to defaulting. And again, we were getting paid 500 over on the basket, and you can see it's a weighted combination of these three. Now, just the takeaway from this chart, let's take a look at the blue line here, the triple Cs. They're paying a little over 10% above treasuries. And they're back essentially to pre-virus or early virus levels, all right? So, in fact, all three categories are. All right. So the nice thing about that is high yield spreads today are not being driven any more or less on a proportional basis than they were pre-virus. In other words, there's still room to run, and you don't have to get all your juice from the triple Cs. But at the beginning, I mentioned there's not only investment grade and high yield in the fixed income class. The other thing you want to think about is EMD, emerging market debt. All right, the ETF you might want to think about there is EMB. EMB is the ticker on that one. Now, the thing about the EMB is it's only dollar-denominated debt. All right, so again, this is debt issued by foreign countries, emerging countries, but it's debt issued in dollars. So we as investors don't have any currency risk. It's just the same as if we bought high-yield bonds or investment-grade bonds in the U.S. No currency risk. Now, the other thing to remember about EMB is it tends to be about, 60% investment grade and 40% high yield, right? So it's like a combination of the two. 60% investment grade, 40% high yield. So you're saying to yourself, well, I probably should get something between the 5% spread on high yield and the 130 on investment grade. Yeah, in fact, you will. So let's take a look at that right now. I'm showing you two here on the screen here. We've got MB Plus, and MB Global. Global is just a broader basket of the MB Plus universe. In both cases, you can see that they're paying about 380, 390 basis points over. So again, somewhere in between high yield and investment grade, closer to the high yield side, even though there's only 40% in high yield. All right. Now, the other thing to notice about this is, again, spreads here have collapsed as well. They have collapsed as well. So that's what I said at the beginning. Nothing in fixed income credit space looks particularly inviting right now. But if you have to be there, at least I want to be someplace where there's some juice left. Someplace where they can tighten more than 30 freaking basis points, like with investment grade right now. All right, so that's our message for today. I hope you've enjoyed this. If you enjoyed this video, help a fat guy out. Please subscribe to the YouTube channel here. So that's our message for today. May your beer be colder than the company you keep. We'll talk again soon. Thank you.